Good to have you here. I think you
Thanks
walked
for
in.
having me.
It's good to have you back, Don. I think I said you walked in. I said I feel like every time you walk in, there's something going on.
Good timing on your side, at least.
It is. It is. Thank you. Sometimes we're just lucky, and we are lucky to have you. What do you make of Strait of Hormuz seeing its biggest day of attack since the Iran and U.S. peace deal? We have the U.S. Treasury Department revoking that waiver that allowed the sale of Iranian oil. We've seen oil prices pop up on this. I get it. It's logical. Is all not over when it comes to our concerns in the Middle East? How do you guys?
It's an important reminder that the downside risks to Middle Eastern supply and the upside risks to oil prices remain very significant. While the interim peace deal is an important step forward, and while oil flows from the Persian Gulf have picked up to about 75% of normal levels, if you include pipelines, a lot of outstanding issues are not resolved. Sanctions, management of the strait, including fees, investments in the region. So we'll have to see how the negotiations go. I think it's a reasonable base case for markets to price in a recovery in Middle Eastern supply, but the risks are still very significant. I think that markets had priced in perhaps with excessive confidence the recovery in supply and perhaps extrapolated to the base case of surplus in 2027, but it's still a highly uncertain environment.
How are you thinking about supply? I think it was just yesterday.
Saudi Aramco that we talked about.
Is there a glut in the market or not?
So I think in the short term, the fact that some of these oil futures curves are in contango, meaning that prices today are cheaper than the price to get a barrel tomorrow, does suggest that temporarily, at least there is an excess amount of supply. Why is that? It's because we're seeing a pickup in export flows that's pretty quick, mostly oil that was produced before, while demand from China is still weak. If you look at import demand from China, it is still down a staggering 5 million barrels per day year over year, which is a 50% drop year over year. So at least in the short term, because it will take time for China demand to recover, and as it's easy to get previously produced oil out, I think temporarily you have a bit of an oversupply. But the pickup in exports doesn't mean that production is necessarily already back and will be higher on a sustained basis.
Are we right on to assume China is going to resume all of the oil production pre this war? Because there's been some narrative around that they didn't love how vulnerable they were, right? We know that they don't produce their own, and so they are reliant on imports and oil, and they have been aggressively moving into alternative energy. So are we wrong to assume that they're going to come back and start buying like they were?
I think the largest oil supply shock ever, the Hormuz shock, will validate the Chinese strategy to diversify into other energy sources and to continue to stockpile. I do think that the weakness we're seeing right now in China crude imports is not sustainable. The fact that you reduce your crude imports by about 5 million barrels per day reflects both destocking, which is, I think, not in line with their long-term agenda to have higher stockpiles. And it also reflects weakness in end-use demand, burning oil for consumption. History suggests that once the availability and affordability of oil products improves, that end-use demand should recover, at least partly. We expect that about 90% of the weakness in oil demand in the second quarter unwinds in the next couple of quarters. But we have some lasting damage, especially in China, where EV sales have surged. Actually, globally, the share of EV cars in global car sales has picked up by about 4 percentage points since the start of the war. So there will be some lasting demand damage, but we think that the extreme weakness in China import demand is mostly temporary.
Okay, so lasting damage, but something that boosts renewable energy?
I think this shock reinforces our views that are structurally bullish on demand for power, demand for copper, demand for battery metals.
Yes, and yes, right?
Yes, and probably also coal, because you can make coal in China. You can make coal in India. It's positive for all the energy and commodity sources made in China, made in India, where you can reduce your import reliance.
But there is an environmental impact. And China at some point, I mean, they've certainly seen it, and they do have to, and elsewhere in this world, have to think about their society, right? I mean, there is that pushback, and it's a reality of there's an impact, there's a cost.
And I think the concern about pollution is a key reason why Beijing has targeted to stabilize carbon emissions by the end of the decade. But I think at least in the short term, until battery technologies improve, there's a limit to how quickly you can ramp up renewable supply. We have seen, again, huge surges in power demand, whether it's in the US or Europe, and the power grid is under strain. And so you need flexible sources of power supply, especially when the sun is not shining, when the wind is not blowing.
Yeah, that's right. And that's the problem. Well, in terms of renewables, and it certainly feels like the conversation here in the US has been dampened, put under the table. We understand things are still happening, but the energy transition, is it still happening from what you are seeing, or is it just a China story? Is it a Europe story? Is it still a global story?
Global story, but I think it's the energy addition rather than the energy transition. Actually,
we need it all, essentially.
We need it all. But if you look at the growth in global energy demand globally last year, it was the first year ever where solar energy was the largest contributor to growth. And it's a pretty widespread phenomenon, including in the US, but also in places like China, but also places like Pakistan, Bangladesh. It's relatively cheap, and you can produce it at home.
Right. Yeah, exactly.
We have to talk about AI. I'm curious if you had to pick one commodity that's going to benefit the most from the AI build out that we're going to see over the next couple of years. I'm on the credit team, so we always talk about the trillions being spent in CapEx to build out data centers and buy chips. What commodity benefits the most from all that?
US power. Especially power in the so-called PJM power market, which includes Virginia, which hosts about 1/4 of the global amount of data centers. Why do we think that power is the big winner from a commodity AI perspective? Because it's this beautiful intersection, from an investor perspective, of very rapid demand growth. US power demand is now growing more quickly than US GDP, and very fixed supply. It's very difficult to add power supply. The queues for gas turbines are 5 to 10 years. Adding a nuclear plant takes, at least in developed markets outside of China, takes decades. And the icing on the cake from an investor perspective is that data centers are incredibly geographically concentrated. They love to cluster together. So that means that you're not only adding a lot of demand in markets with constrained supply, you're doing it in a hyper-concentrated way. So we think that some of these local power markets, like the PJM power market, are probably the best bullish commodity expression of a bullish data center view.
That's interesting.
Copper would be my second pick.
Copper would be your second pick. Is there any hesitation, though, that the build-out and the power demands will somehow equalize or pull back, that there's just so much right now, but as chips become more efficient, or maybe we realize the ROI on AI investments that maybe we don't need it all? Like, is there some reality check at some point? It's possible.
But at least for the next couple of years, the pipeline looks very, very strong.
You really feel like you have that much clarity?
So we look at a data set with all the schedules for data center additions.
Yeah.
We take into account the historical tendency for delays and for some of the projects to get canceled. But even taking into account those revisions, that model suggests that U.S. demand for power coming from data centers will double by the end of 2027.
Do we have the grid to handle all of this?
Not in all places. And so I do think that places like, for instance, Texas, Georgia, where they're in a way following the Chinese strategy of adding all of these above, renewables, but also natural gas, nuclear, where it's easier to add power supply, that those are the best positioned states to attract all these data centers.
Fascinating. It all ties together.
It all ties together. We have to get the AI angle in there.
Yeah, no, but it's such a big part of it, right?
It's huge. Yeah, it's huge. Also a key driver of price action in metals. Our preferred trade for industrial metals is a long copper versus aluminum, because copper has a stronger electrification and AI exposure. More than 50% of copper demand is tied to electrification, and copper supply is very, very constrained. In general, we think investors should focus on commodities with constrained supply and a strong demand outlook, whether it is US power, gold, or copper.